Welcome to Mayor Brown's Global Financial Markets Podcast. Each 30-minute episode is designed to help listeners better understand the legal issues that impact their business given the ongoing uncertainties in the financial markets worldwide. Speakers from across Mayor Brown's practices and offices provide their timely insights on a wide range of topics, including finance, financial services, and insurance regulatory developments, securitizations, and litigation in the United States, the United Kingdom, Europe, and Asia. We hope you enjoy the program.
Hello, listeners. Our topic today is Mortgage Market Update Part 1, Bank Capital Requirements and Related Developments. My name is Susannah Schmid. I am a partner in Mayor Brown's Banking and Finance practice in our Chicago office. Joining me today are Mayor Brown partners Miller Smith, Brian Kuhl, and Matt Bisanz. Miller and Brian are also partners in our Banking and Finance practice in Charlotte and Chicago, respectively. Matt is a partner in Mayor Brown's Financial Services Regulatory and Enforcement Group in our Washington, D.C. office. With that said, let's begin. Matt, I turn it over to you to introduce yourself and provide your insights on recent developments related to bank capital requirements.
Thank you, Susannah. So yes, as she said, I'm a bank regulatory partner in the firm's DC office. I've been with the firm about 10 years, focusing on all types of bank regulatory issues. For today's topic, though, I have been focusing on the Basel III capital rules for what seems like forever. That I remember when these were new in 2013, and now hearing that they will be new again in a few months is a little intimidating for me. But until they are new, or at least until the next several years when they are phased in, my last 10 years of knowledge will serve me well. And that's what I hope to convey here today. So since the 1980s, the U.S. banking regulators have required U.S. banks to comply with minimum capital requirements and capital adequacy standards. And this was done in response to some of the issues with the savings and loan crisis in the 1980s, where you had S&Ls going bankrupt because of declines in values in their mortgage books, which are their assets. And so you would end up with a situation where the mortgage declines in value as say customers default, and then the bank becomes insolvent because it has fewer assets than its liabilities. And so capital is intended to protect a bank against declines in assets, because capital is that amount that sits above the liabilities that is on a bank's balance sheet is the first loss absorbing piece of the bank. And so in order to protect against declines in assets, you have to have sufficient capital. But bankers and lawyers, the smart people that we are, have found ways to design that buffer in ways that are most friendly for our clients. And so over the years, the regulators have put in place increasingly complex and restrictive mechanisms to ensure adequate capital. And currently, there's more than a dozen ratios of the amount of capital versus the amount of a bank's assets that it's required to hold. Different ways to calculate the amount of capital, ways to look at on and off balance sheet assets, and also different ways to calculate the amount of the bank's assets, either on a risk basis, on a total basis, again, ways to look at off balance sheet assets. But for our purposes here today, we're going to talk about first in a relatively simplified format. We're going to talk about the numerator of the general ratio, which is the capital. It is typically common stock, retained earnings, preferred shares with certain attributes that make them unlikely to be sensitive to stress events. So, lack of redemption features, regulatory approval for redemption, all those types of things. And then, as I said, the denominator will vary greatly on the ratio being calculated. But to, again, try to keep it simple for a mortgage-focused audience, we'll assume we're talking about most regional banks in the U.S. and larger, say, U.S. presence of international banks, which use the standardized approach to capital. And also, we'll assume that we're only talking about the risk-based capital rules, because that's the approach that regulators use, where they say, look, let's take all of the assets on a bank's balance sheet and let's adjust them for the actual credit risk that is present in the assets. That Some assets may have a large dollar value to them, but we know they are very unlikely to decline in value due to credit losses, just because of the nature of the obligor or the borrower, other features inherent in the asset exposure. And so risk weighting adjusts the historical cost value of the asset to reflect its true credit risk. And just as an example, say you have a bank has an investment in U.S. Treasury bills. That is a defined asset, known face value, and it is an obligation of the U.S. federal government. It is unlikely that the U.S. federal government would default in a credit event. Again, has not happened for decades, if not centuries. There's no expectation it will. And so we can say that, well, look, these are relatively credit risk-free assets. And so we don't need to hold capital against them. And so we'll assign them a risk weighting of 0% because there's no need to hold capital against them. If we look at another kind of asset, we might say, look, we have other we might have an exposure to another bank that we might have maybe entered into a repo with another bank. And there's a chance the other bank in the U.S. will default, but it tends to be fairly uncommon for insured banks in the U.S. to default on their obligations for credit events. And so the regulators might assign that a risk weight of 20%. There are other types of assets, though, that are much higher on the risk spectrum. And so when you're looking at something like a high volatility commercial real estate loan for constructing commercial real estate, and it may be changing in value as the property is completed, developed, put into operation. The bank has a fairly high level of exposure because not only is it the face amount of the loan, but it's also the potential of being stuck with this, of having to complete construction on a property, of other types of liability that it might have. And so for these, they might have a risk weight of, say, 250%, where the bank's exposure, the regulators deem it to be greater than the face value of the instrument. And if you look at things like esoteric equity instruments, those can go as high as 4, even 600%. Or with securitizations, if done incorrectly, can go as high as 1,250%. And that just reflects the regulators' concern that not only would you have to hold enough capital for a normal decline in the face value of the instrument, but the entire instrument could be wiped out in a way that depletes the bank's capital. Most exposures are not as bad as a 1,250% risk weight. The default is 100%, meaning that you need to hold roughly 8 to 10 cents on the dollar in capital for every dollar of corporate exposure. That's also the general risk weight for commercial real estate. It's the risk weight for things like mortgage warehouse facilities or warehouse lines of credit that are drawn upon. And so for most real estate purposes, we'll talk about 100% risk weight. The one exception to it dates to an exception that Congress actually put in place in the early 90s to encourage the residential real estate sector. And it says that if you have a first lien residential mortgage that is secured by an owner-occupied or rented property, it's made in accordance with prudent underwriting standards and a FIRREA-compliant appraisal, and is not more than 90 days past due or in non-accrual status, and also is not restructured under, say, a TDR. So if you check all those boxes to say that you have a relatively conforming good mortgage, then you can give it a 50% risk weight. And that was recognizing that if banks had to hold less capital against these good resi mortgages, then the banks would be more likely to make the mortgages, more likely to make them at a lower interest rate, and that would encourage home ownership in the U.S., which is that wonderful goal that Congress has set forth. But other than that kind of preferential resi mortgage risk weight, most of them are going to be at 100%, which again means you have to hold 8 to 10 cents on the dollar of capital for every dollar of loan exposure. That it can get expensive for banks, and particularly in a rising interest rate environment, that can get expensive because while the 100% is tied to the historical value of it in recognition of the fact that there aren't going to be a high number of credit loss is expected. Obviously, the bank is still affected by interest rate and market risk. So on a fair market value, that loan is actually declining in value because the bank's opportunity cost of capital is going up. That the loan doesn't change over time, or the value of the loan doesn't change, but the cost of the bank's equity increases in a rising interest rate environment. And so that historical loan that might have been made 5-10 years ago, that is becoming increasingly more expensive for the bank to hold as interest rates go up and the relative value of the loan declines on a fair market basis. And so banks are faced with this compression of, well, we'd like to make new loans at a higher interest rate. We might be able to get more net interest margin by doing that, but you've already used up our equity on making these historical loans that if, say, they're a resi mortgage, they won't roll off for 15-30 years. And so we really don't have much capital capacity. New capital is expensive to raise. And so we have this problem of we're getting compressed, that we want to make new loans at higher interest rates, but we don't have the capital base to support it. And so that is a problem that banks are confronting as they look at their capital positions relative to the lending market. And I think you've seen probably in the last year or two, and my colleagues on this call will know it better than I do, of a huge decline in mortgage loan originations, that the pipeline in many areas is running dry. People are having to get more creative with filling their warehouses and securitizing into the market. And even at the corporate level, that I saw some headline yesterday about how commercial real estate is facing similar pressures on it as banks just struggle to find the space on their balance sheet to fit in new higher interest loans, and borrowers really want to put as much pressure as they can on those interest rates to keep them down. And so I think what some of my colleagues will talk about is what they're seeing, but also Brian in particular has been looking at ways to get some relief from these capital requirements that I just talked about. So Brian, would you like to take it?
Thank you, Matt, for that great overview of bank capital requirements. My name is Brian Kuhl, and I'm a Chicago-based partner in Mayer Brown's banking and finance practice. I'm going to discuss ways in which banks can reduce capital requirements through capital relief trades, which I'll somewhat generically refer to today as synthetic securitization. So synthetic securitizations leverage existing features of the regulatory capital requirements and can be completed by almost any banking organization. On today's podcast, I'm going to first discuss the requirements of a synthetic securitization and then describe the different types of deal structures for synthetic securitizations. I'll then provide an illustration of the benefits of a sample synthetic securitization, and finally, we'll explain why a banking organization may choose to do a synthetic securitization rather than a traditional cash securitization. First, in order to realize the benefits in reducing risk-based capital requirements that Matt was talking about, a transaction needs to comply with the definition of synthetic securitization and also needs to conform with the initial and ongoing operational and due diligence requirements for synthetic securitizations. As an initial matter, the definition of synthetic securitization requires that the transaction meet the following 4 requirements. 1, all or a portion of the credit risk of one or more underlying exposures is retained or transferred to one or more third parties through the use of one or more credit derivatives or guarantees. 2, the credit risk associated with the underlying exposures has been separated into at least 2 tranches reflecting different levels of seniority. 3, performance of the securitization exposures depends upon the performance of the underlying exposures. And 4, all or substantially all the underlying exposures are financial exposures, such as loans, commitments, credit derivatives, guarantees, receivables, asset-backed securities, mortgage-backed securities, other debt securities, or equity securities. In addition to these 4 definitional requirements to qualify as a synthetic securitization, a deal must satisfy the following 4 operational requirements. 1, the credit risk mitigant is financial collateral, an eligible guarantee, or an eligible credit derivative. 2, the banking organization transfers credit risk associated with the underlying exposures to one or more third parties, and the terms and conditions in the chosen credit risk mitigant do not include certain prohibited provisions. 3, the banking organization obtains a well-reasoned opinion from legal counsel that confirms the enforceability of the credit risk mitigant. And 4, any cleanup calls relating to the securitization meet certain specific requirements. So given this basic background on the definitional and due diligence requirements, I'll now describe the different types of transaction structures. There are 3 primary types of synthetic securitizations, each with its own benefits and drawbacks. The first type is a standard credit default swap or guarantee. The primary advantage of this arrangement is that it's bilateral and it's relatively simple. But the downside is that the credit default swap or guarantee is illiquid and cannot be sold or leveraged, which negatively impacts the pricing. Additionally, a credit default swap or guarantee must satisfy certain additional eligibility requirements that often are difficult to satisfy as a practical matter. A second type of synthetic securitization is credit-linked notes issued by a special purpose vehicle formed by the banking organization. A credit-linked note, or a CLN for short, is a security with an embedded credit default swap or guarantee that permits the issuer to shift specific risk to credit investors. In these deals, the CLNs are fully funded at issuance, and the proceeds of the CLN issuance are deposited into a trust account for the benefit of the bank and the CLN investors. If the cash in the trust account is used to make credit protection payments to the bank, payments on the CLNs are also reduced. Transactions containing CLNs issued by special purpose vehicles are more common outside the United States. These structures are more liquid than bilateral credit default swaps or guarantees, but may raise additional costs and legal issues when compared to CLNs issued by a bank, which is the third common transaction type. Bank-issued CLN transactions are very similar to transactions involving CLNs issued by special purpose vehicles, except that the CLNs are unsecured debt obligations of the bank rather than limited recourse debt obligations of the special purpose vehicle. Transactions with bank-issued CLNs are more common in the United States. These transactions are also more liquid than bilateral credit default swaps and guarantees, but also do not raise some of the legal issues and additional costs that arise in deals involving CLNs issued by a special purpose vehicle. Any of these 3 types of structures can provide banking organizations with the same regulatory capital benefits. I'll now provide a brief and simple illustration of how a banking organization can use the bank-issued CLN structure to reduce the capital charge for a pool of residential mortgage loans by as much as 80%. To begin, as Matt was talking about, a portfolio of residential mortgage loans not subject to a synthetic securitization will be given a risk weight of 100%, or in certain limited circumstances for certain types of mortgage loans, it may be 50%. For this example, we're going to use the 100%. A banking organization generally would be required to maintain a total capital ratio of 8% for such assets. For a portfolio of loans valued at $1 billion, then, the banking organization could be required to maintain regulatory capital equal to $80 million, i.e., the product of 8% capital ratio multiplied by 100% risk weight multiplied by $1 billion value of the portfolio. If the banking organization attaches that $1 billion portfolio of loans to a synthetic securitization, the regulatory capital requirement could be reduced from $80 million to $14 million, which would free up $66 million for the bank to use for other purposes. To achieve this, the banking organization would issue a junior tranche or tranches to a third party valued at $125 million, which is 12.5% of the value of the $1 billion pool. The risk weight of this junior tranche could be as low as 0% if it's properly collateralized, which is typically collateral that is cash sitting in a collateral account. So the banking organization's required capital hold for the junior tranche would be $0. The bank would then also issue a senior tranche valued at $875 million, which the bank would retain. Because the securitization exposure is given a risk weight of 20%, the banking organization's required capital hold for the senior tranche would be $14 million, i.e., the product of 8% capital ratio multiplied by 20% risk weight multiplied by $875 million value of the securitization exposure. So by attaching that $1 billion portfolio of residential mortgage loans to a synthetic securitization, the banking organization reduces its regulatory capital requirement by $66 million, from $80 million down to $14 million. The illustration I just provided evidences the value of a synthetic securitization to a banking organization, but why would a banking organization choose a synthetic securitization over a traditional cash securitization? The answer is simply that synthetic securitizations offer banking organizations an easier method of receiving capital relief when compared to more traditional cash securitizations. In a cash or traditional securitization, the bank will receive capital relief only if it's able to de-recognize the risk-weighted assets transferred into the securitization under the GAAP rules. However, achieving GAAP derecognition may be difficult due to changes that were made to the GAAP rules after the global financial crisis of the late 2000s. To achieve derecognition, the assets must be considered removed from the bank's balance sheet from a GAAP accounting standpoint, which is different and a more difficult analysis than simply legally transferring the assets to a special purpose vehicle. This is particularly true if the bank retains tranches and/or control of the securitization vehicle, which is a common feature of cash securitizations. In a synthetic securitization, on the other hand, the risk-weighted assets are not removed from the bank's balance sheet, but rather remain on the bank's balance sheet. Therefore, synthetic securitization allows a banking organization to achieve capital relief without any GAAP analysis about derecognition of assets. In conclusion, banking organizations that hold residential mortgage loan portfolios on their balance sheets should consider the benefits of using a synthetic securitization transaction to convert the capital treatment of their exposures from wholesale or retail exposures to securitization exposures, thereby reducing the amount of risk-based regulatory capital that the banking organization is required to hold in support of the residential mortgage loan portfolio by as much as 80%. I'm now going to turn it over to Miller Smith, who will discuss warehouse structuring.
Thanks, Brian. My name's Miller Smith, and I'm a partner in the Banking and Finance Group in Mayor Brown's Charlotte office. And I'm going to speak to you today about mortgage warehouse structuring as it relates to bank capital requirements, and in particular, considerations for obtaining traditional securitization treatment under the U.S. regulatory capital rules for commercial mortgage warehouse facilities. So many commercial mortgage loan originators use warehouse financing as a temporary or permanent source of leverage for their loans. The most common structure for commercial mortgage warehouses is a repurchase facility, which is in many ways similar to a bilateral loan agreement. In both structures, the mortgage loans that serve as collateral are transferred or pledged to the lender as collateral in exchange for an advance, and there is typically a guarantee in favor of the lender from a creditworthy affiliate. As Matt noted earlier, in a rising interest rate environment and with the heightened focus on regulatory capital treatment generally in the market today, bank lenders in the mortgage warehouse finance space have become increasingly interested in ensuring that their deals are structured such that they can achieve traditional securitization treatment, resulting in a much more favorable risk weighting. And while we won't have time today to go into all the details of what's required to satisfy the traditional securitization definition under the U.S. regulatory capital rules, I'd like to highlight just a few key structuring points for consideration in entering into new deals. First, in order to satisfy the requirement that the credit risk associated with the underlying exposures has been separated into at least two tranches reflecting different levels of seniority, it's important to consider the advance rate under the facility as well as any recourse guarantee level. Typically, advance rates in these deals are no more than 80%, and credit recourse from a guarantor would be capped at no more than 25%. But a higher advance rate or credit recourse level might strain the analysis with respect to that tranching requirement. This guarantee level is also a consideration in the criteria that requires the performance of the securitization exposure to depend on the performance of the underlying exposures. For instance, a full recourse guarantee would make it such that the bank lender's exposure would not be dependent on the performance of the underlying loans. And lastly, this guarantee level is also relevant in determining whether all or a portion of the credit risk of one or more underlying exposures is transferred to one or more third parties other than through the use of credit derivatives or guarantees. With full recourse facilities to SPE borrowers, where the bank lender would be entitled to pursue all of the borrower's assets if there's an event of default under the financing, the structure lends itself to the conclusion that the credit risk from the underlying loans is transferred entirely to the bank lender. However, again, if you have a full recourse guarantee, that would cut against the analysis. So it's important to consider the recourse guarantee level and confirm that it doesn't create any issues under these three criteria. Another structuring consideration is whether to permit the borrower to originate loans directly. In many of these deals, loans are originated by an existing operating company and transferred to a newly formed borrower SPE in connection with the financing. However, some institutions prefer to originate loans in the name of the SPE borrower directly. And because borrowers do not typically profit from this origination and generally would pass through any fees earned in connection with origination to a parent or affiliate, the criteria for traditional securitization that requires that the underlying exposures are not owned by an operating company may be satisfied, but it's definitely more favorable for the analysis if the SPE borrower counterparty is not originating the assets and or earning fees in connection with origination. So in considering commercial terms that are consistent with traditional securitization treatment of a commercial mortgage warehouse facility, it's important to focus on the recourse guarantee level, the advance rate, and borrower origination or any other profit generating activities. And now I'll turn it over to Susannah to speak about some EU regulatory capital matters.
Thanks, Miller. I am Susannah Schmid, and as previously noted, I'm a partner in Mayer Brown Banking and Finance Group focusing on warehouse lending in the residential property sector. I'm going to supplement Miller's topic and speak to you today about considerations for mortgage loan repo warehouse facilities as it relates to EU capital treatment. In the past, many EU regulated banks would account for their mortgage loan repo arrangements as secured lending on their books. With the ongoing impending implementation of new Basel rules, as Matt discussed, and the current draft formulation of Capital Requirements Regulation 3, mortgage loan repo arrangements categorized as secured lending would require most banks to maintain a greatly increased level of capital on their books. As a result, many EU-regulated banks are looking into the possibilities and parameters for booking their mortgage loan repo structures as something other than secured lending. One possible solution is to structure these transactions to qualify as securitizations. However, to qualify as a securitization, among other requirements, the EU bank would likely need to require the mortgage loan counterparty or seller to comply with European risk retention, which requires full Article 7 reporting in the form of prescribed templates. For U.S. companies that don't typically provide this level of information and data, the requirement can be overly cumbersome and expensive. In addition, payments in the securitization structure must be dependent on the performance of the exposures, which, as Miller noted, complicates the issue if a full recourse guarantee is desired. Another possible solution would be to structure these transactions as securities financing transactions, or SFAs. Under the current formulation of Capital Requirements Regulation 3, the capital treatment for SFAs is typically better than that afforded to secured lending transactions, though typically not as favorable as the treatment for securitizations. To structure a warehouse financing transaction as an SFA, the transaction needs to be a sale or repurchase of securities. Whether a transaction achieves this status will largely be dependent on facts and circumstances relating to the asset sold, and whether internal bank protocols are comfortable that the asset can be considered a security. Depending on these protocols, it may be that to achieve security status, the bank will need an offering memorandum with a CUSIP bond, or perhaps something more simple. Again, this will largely depend on the bank's own internal comfort with security treatment over different types of assets. While there may be other possible alternatives to structuring repo loan facilities to achieve a desired alternative to such a transaction being categorized as a secured loan for EU capital treatment, the primary two we have seen in the market are to consider structuring as a securitization or as an SFA. So, for banks subject to EU capital requirements, it's important to begin considering if treatment other than secured lending is needed for repo structures, and if so, what treatment is most practicable given the circumstances. And with all of that said, I want to thank each of our speakers today, Matt, Brian, and Miller, and thank you to our audience for listening. Listeners, if you have any questions about today's podcast or anything else related to global financial markets, please email us at gfm@mayorbrown.com. Thanks for listening.
We hope you enjoyed this program. You can subscribe on all major podcasting platforms. To learn about other Mayor Brown audio programming, visit mayorbrown.com/podcasts. Thanks for listening.